Meanwhile, in that same 40-year period, we've had the booms and the busts and the booms and the busts and the booms and the busts. We had the Great Recession, we had COVID, we've had all kinds of recessions and expansions in between that whole 40-year period, ups and downs and ups and downs. Self-storage, steady, generally speaking.
Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
Hi, and welcome to another episode of the Gentle Art of Crushing It podcast. My name is Sean Graham, and I'm one of 6 hosts who bring you conversation 3 times a week on a variety of topics around real estate, business, mindset, personal motivation. So our goal with this podcast is to help you succeed in whatever target you're aiming at. We're committed to finding the best and the brightest people who aren't just talking about doing big things, but they're actually taking the steps and the actions to achieve their dreams. And we want to help you along the way. So today is no different. I am joined by the one and only Tom Dunkel. Tom is the co-founder of Belrose Capital, which has over 11 self-storage facilities under management. Tom has been active in real estate and finance for over 25 years, and Belrose is actively growing and has a couple syndications underway right now. So without further ado, let's jump into it. I am your host, Sean Graham, and today I have with me Tom Dunkel, and we are here to focus on self-storage. Tom is a partner at Belrose Storage Group, and he's been investing in real estate and self-storage for several years now, but we just brought him on to have another investor here and talk storage. Tom, welcome to the show.
Thanks, Sean. It's great to be with you and all the listeners today. Appreciate the invite.
Yeah. I see you have the Who Not How book there in the background. That's one of my favorites. But
absolutely.
Tell me a little bit about your background and what you guys do over at Belrose and kind of your real estate experience.
Sure. Well, since you brought it up, Who Not How is one of the things that's really kind of been ingrained here at Belrose Storage Group. Because I have to tell you, Sean, I've been in the finance and real estate investing business for 27 years, and I find that when I get a good team around me, when I get the good people, and we get a good culture with strong core values that bind us together, that's when I've been the most successful. And so that's one of the things we're really focusing on here at Belrose Storage Group. But just to back up, and the reason I've kind of keying in on that, because it's a great way to start the show, is when of course the book hadn't been written yet, but when I got out of business school and started in my career in the late 90s, I was with an aerospace company, and we were growing aggressively through mergers and acquisitions. So I was a financial analyst, I was a spreadsheet nerd, I was doing building the spreadsheets, doing the valuations, doing the projections to not only value the target company, but also to put the investor and bank packages together so that we could go and get the financing for the deals. So the CEO of that company was a Harvard MBA, Harvard undergrad, First Boston Investment Banking, just a really sharp guy. He was only in his 40s at the time too, and the company was doing over 100 million of revenue, but he saw this company as a platform upon which to grow the business. So of course, with his pedigree and his background, he was able to attract fantastic people around him. So the senior vice president of corporate development was a Naval Academy graduate, went into he was actually a Gold Glove boxer at the Naval Academy, went into did his tour in the Marines, and then from there went to the Wharton School at the University of Pennsylvania for his MBA. And so that's just a little flavor of the people that were in that group that I was helping to support. I was just a young guy fresh out of business school,
sure,
running the models and such, but just being around those fantastic people, retired fighter pilots, retired Air Force colonels, and there were even some astronauts on our board of directors and in that crew as well. So it was a pretty amazing group. So that was kind of the foundation for me to then, learn how to do deals, learn how to put these projections together, learn how to do underwriting, get the financing together. What are the key things that lenders are looking for? What are the key things that private equity investors are looking for? So that was what I, really cut my teeth in back then. Fast forward to today, I finished up my corporate career in 2006 after, bouncing around to a few other companies. Some of the companies did not have great people, frankly, in the leadership team. Those companies didn't do as well. So I'm kind of learning as I'm going along that even in the corporate world, you've got to have those strong teams. So I left corporate America 2006. Actually, I got fired from my corporate job, but it was a blessing in disguise because it forced me out into my entrepreneurial career 17 years ago, which is what I believe was meant to do anyway. So my first venture, of course, 2006 wasn't a great time to get into real estate, but that's what I did. And I also didn't do a good job of surrounding myself with very good people. So, of course, you combine that with the fact that the market was, crumbling beneath my feet. So those first few years of my entrepreneurial career were pretty difficult, to say the least. But then I started getting a little smarter, started surrounding myself with the right people with similar values, similar goals. And then now today with Belrose Storage Group, we've been extremely intentional about putting a great team together, because I found that I, of course, kind of did it by accident in my aerospace days. I didn't know joining that company I was going to be around these amazing people. But then later on, when I did connect with my business partner, Joe Downs, we've now been business partners 13 years. He and I have very similar values, so that was important. So I kind of did it by accident. And then when we read Who Not How, I was like, oh, well, now it all, makes sense, seeing it there in black and white in the book. So when we came around to Belrose Storage Group, we really liked storage. That was kind of the first thing, but we knew we had to put a great team together. So we went ahead and did that. And we've been able to acquire 14 facilities over the past, 2.5 years or so. And we just got a solid group. We've got much more ahead of us. We've got a mountain to climb, but we've got a great team here.
Wow, that is awesome. Yeah, I actually read that book or listened to it on Audible beginning of the summer, Who Not How. And, it seems very just intuitive, right? It's like, okay, who not how. So you delegate things, automate things, and you find the right people in the right seats. But the more I got into it, the more I started noticing the wrong people doing the wrong things. The who is the wrong who's doing the how. And it was killing me in some ways, right? Just like wasting time. So it's something that I'm constantly learning about, but I love that. I love that book. Kind of going back, it's interesting. I have a similar kind of background. I was in corporate and I was working for like a private equity backed company, and my background was accounting and finance, and I was a CPA, right? But I was surrounded by all these big guys who were like people who had MBAs from Harvard, and just very prestigious degrees. But I always knew in my heart, like, I was an entrepreneur and I was there to learn. But when you go back and you look at that experience, would you say you always wanted to be an entrepreneur? And how did you feel? Like, because you have a MBA from William and Mary, and so I don't know if you got that during that time or before. But how did you feel just being surrounded by all of these people with these elite degrees, and how did that kind of shape you?
Yeah, I mean, they're certainly, super, super bright people, and just enjoyed being around them, and, having them challenge me to, do better in my role as the financial analyst. So I think I really grew a lot. I kind of took on that challenge. So that was really great. But I'd have to say that as far as translating that into my entrepreneurial career, I had an interesting experience, Sean, when as I mentioned earlier, I got fired from my corporate job in 2006. But as I was looking for something entrepreneurial to do, I thought, well, I've got a 4-year-old and a 2-year-old at home. the breadwinner. So, I really need to hedge my bet a little bit. So while I was looking for entrepreneurial jobs, I also was looking at some corporate jobs.
Right.
And even though I didn't, I just really didn't want to go back, I thought, well, for the sake of my family, let me take a look at that. So I ended up getting recruited by this really amazing company. It was a global company. They were looking for a senior mergers and acquisitions guy, which at that point I had about 12 years experience
Okay.
and doing deals and whatnot. So everything, if you had said, here are the criteria for the job, and then, here's Tom's skill set and resume, you would think that there would have been a perfect fit there. And on paper, that was absolutely true. But as I'm sitting there in the interview across from the guy, you kind of, when you're in an interview, you kind of get a sense of, if they want you or not, right? So I was
Sure.
getting some very clear vibes that I was their guy. They really wanted me. And as I'm sitting there, I could hear this little voice in the back of my head saying, don't do it. Don't do it. You need to go out and do your own thing. Don't go back into the corporate, bubble. And this was a big job. I mean, it was, multi six-figure base and bonuses and pre-IPO stock options and all this stuff. I mean, everything just lined up perfectly. Again, if I had been wanting to stay in the corporate world. But when I heard that little voice, I knew that I was either certifiably insane or I truly was an entrepreneur, and this was my opportunity to really kind of break free from corporate America and go for it. So, thankfully I did that 17 years ago, and it certainly hasn't been easy. Had to, scramble through the Great Recession, and we've had ups and downs. We've had multiple businesses and have been investing in multiple asset classes along the way. We've been in great partnerships. We've been in bad partnerships, kind of going back to the who, not how, and the people aspect.
Right.
We've had some great employees, and we've had some employees that just didn't meet our expectations. So, we've kind of had everything in between, but, I really wouldn't change it for the world, Sean. I'm really excited and kind of proud of where we're at today with Belrose Storage Group. And it's just been a lot of fun, and been able to work with a lot of investors and helping them meet their wealth building goals. So that's, of course, a huge thing for us. It's really part of our core purpose here at Belrose Storage Group. We love storage, but really at the end of the day, we don't really care much about what we're investing in, as long as we're generating, that income and that growth and preserving capital for our investors.
Yep. I hear you. That's a very interesting story. I also got fired from my corporate job, and I decided I'm done. I'm not looking back. I'm not going back. It's I kind of always felt it like, no, you're meant to do something on your own, and you just had that itch. And I kind of took it as like, hey, the universe is telling me something here. This is an opportunity. But I didn't have two kids. I had a wife, right? But I didn't have two kids. And to do it with a 2-year-old and a 4-year-old, that's pretty bold, I'd say.
Well, I guess fortune favors the bold, so I don't know.
There you go.
Thankfully, it worked out for me. I wouldn't recommend going that route for anybody out there that might have a 4-year-old and a 2-year-old, and they're getting a little itch to leave corporate America. I would try to do it in a more phased-in fashion than what I had to do. But
sure, everyone has their own.
Got to make lemonade out of lemons, I guess.
Yep. So tell me a little bit about Belrose, and when did you form that? How did you guys come about? And like for the investors out there, right? There's so many self-storage syndicators out there now. Like, why work with Belrose? Why put your money with Belrose? What are you guys up to?
Sure, it's a great question, Sean. I would say it kind of goes back to our whole track record. Having a team, led by me, my partner Joe Downs. He has a similar background to me. He was in corporate America. He's a financial advisor for a number of years. He's been in commercial real estate. He was doing tenant and common syndications. I don't know if anyone knows what that is, but you can Google it if you get a chance.
I've heard of those.
Anyway, yeah, so it's basically just big syndications, primarily for 1031 exchangers. But so he got creamed in the Great Recession as well, and it was shortly after that we met. But I think our track record in not only self-storage, but in multiple asset classes. So I think that's helpful for investors to know because we're not just a one-trick pony. We love storage. We found storage about 2017, 2018. We really started, is when we started going to the conferences. 2019, we joined a nationwide self-storage mastermind group.
Okay.
So we didn't even buy our first facility till 2020 when we had our education in place, we got our team in place, and it wasn't until then that we felt comfortable enough to go out and start acquiring facilities. So we came in very intentionally, very purposely, and I think it's been paying really nice dividends. Our investors have been realizing great returns with us. We've had a few exits, and they've all exceeded expectations. And so those investors, which is what we love to see, is they come back and they reinvest in our next deal, and they upsize their investments and they bring their friends. So that's pretty good evidence to us that we're doing a good job for them. But we've been around the block. We've been in multiple asset classes. We've been successful in multiple asset classes. We've certainly made some mistakes along the way, but we have that background and those experiences, so that we make sure that we are doing right by our investors. And on top of that, we invest in all of our own deals as well. So we eat our own cooking. We're right there alongside our investors, for good, bad, and the ugly.
Good. Yeah, I was looking at your website, and I see here, your core values, and you guys have this principled, SEAL team, champion, gritty, and Gumby. And I was just, some of these, it makes, like, I know, and some of them I'm like, well, tell me a little bit more about that, like SEAL team and Gumby. So I just didn't know, maybe you could kind of talk about these a little bit.
Yeah, absolutely. Well, principled, of course, is really important. At my business school at the College of William and Mary, our dean, Dean Larry Pulley, who he just retired. He had been there for, I think, 26 or 27 years, but he was a great guy and did a great job as the dean of the business school. And his whole thing was about principled achievement. So. Okay. Yes, everybody should be going out there and trying to achieve, but you need to do it in a principled way. And so that has stuck with me throughout my career, and so I brought that with me here to Belrose Storage Group. Champion is actually the verb form of champion. So we champion each other, we applaud each other, we pick each other up when we're down. We really try to be cheerleaders for everybody on the team. SEAL team is, of course, referring to the Navy SEALs, but what do the Navy SEALs do? Well, they plan like crazy, right? They plan all the details. They're in shape. They're ready to go. They've got the tools. They've got the equipment. And when it comes to execution, they execute come hell or high water, right? So they are, going into battle as a team. And when you're trying to buy a self-storage facility or run a self-storage facility, or you're inevitably going to run into problems, challenges, obstacles, right? And so you want to make sure that you've got that who, not how. You've got that team around you, so you can rely on each other and get the job done.
Sure.
Gumby relates back to the I think the 1960s, claymation cartoon. Gumby was kind of the always a very cheerful, flexible guy. So even though we might run into some challenges in business, you got to be cheerful, you got to be flexible, and you got to do right by your community as well. Gumby was always a good neighbor in those old cartoons.
I like that.
And then lastly, gritty. So if you're not from the Philadelphia area, you might not get this bit of humor, but our ice hockey mascot for the Philadelphia Flyers is a guy named Gritty. So of course we started with grit, which is something that all entrepreneurs need, or anybody that's really taking on any big challenge. You got to have grit, right? But so we turned it into gritty just to kind of, pay homage to our, Philadelphia roots here. And so, of course, gritty, having grit or being gritty just means, plowing through the difficult times, always trying to do better, Just grinding things out when you have to grind them out. If that means you got to stay late, you got to stay late. If you got to work on a weekend, you got to work on a weekend. But then, of course, we like to encourage our team as well to, then take some well-deserved time off as well with their families.
I like that. I like that. Yep. One of mine is persistence. So, which
Yep.
lines right up there with gritty. And I think every entrepreneur, especially, in these harder times like this with, interest rates high and the economy a bit tight,
That's right.
you have to be persistent, and you have to stay principled as well. It's easy to not, to get off course and start doing deals that you shouldn't be. But yeah, those are great. Those are great
Yep.
core values. Tell me a little bit about, I guess, like the deals that you are doing, and like what you have on the horizon, and what kind of self storage facilities are these? Are they class like A, B, C? Are they, do you target specific areas, populations, demographics, that sort of thing?
Sure, yeah. So we, to this point, Sean, have been what I would call a value add self storage shop. So
Right.
what that means is we're buying existing self storage facilities, and they're generally going to be maybe C's, maybe even a C minus, maybe a C plus. But we go in with our proven value add strategies and our world class operations team, and we turn those facilities around, and we get them to up to the a few steps ahead. So if it was a C, we try to get it to a C plus or B minus. And the way that we do that is really pretty straightforward. We're certainly not splitting atoms here, but it's just blocking and basic business blocking and tackling kinds of things. So we're putting systems in place, right? We're putting management software in place. We're leveraging technology as much as we can to help to run the facility more efficiently, and so that our customers have a better experience. We're pushing rates is a big thing. So the facilities that we acquire, a lot of times we're acquiring them from moms and pops, and they just want the units full, and they want their mailbox money coming in each month. So they're not really analyzing the market to see like where is that supply demand curve equilibrium where they can push that price for a unit. We do that, and so that gives us the ability to come in and a lot of times push rates. We also add revenue streams like tenant protection. But basically, we run it like a business. We don't run it like a side hustle, right? So we run it like a business, and we're able to increase the revenue. We monitor the expenses. We're able to increase the net operating income over a short period of time, which that translates in commercial real estate like self-storage into a higher valuation. So we exit the facility at that time and generate great returns for our investors. And so right now we are basically up and down the East Coast. We've got a facility in upstate New York. We're in Maryland, Virginia, North Carolina, Georgia, Florida, Kentucky, soon to be Alabama, and we're looking at some deals in the Midwest in Wisconsin and Minnesota.
Okay.
So yeah, we're kind of starting to head out that way.
Awesome.
I'll mention two exciting niches within the self-storage niche that we're really taking a good hard look at and starting to, these next couple acquisitions we have lined up will get us into those spaces. Of course, traditional storage is awesome. We're going to continue buying those beautiful metal boxes with concrete floors and roll-up doors. We love those. But there's two exciting areas that we're looking into here at Belrose Storage Group. One is contractor storage. So these are larger units with higher ceilings. The unit is large enough so maybe you can pull in a truck or a van, something like that. It's big enough where you can store materials, equipment, etc. And this is important because there's a lot of contractors out there who got screwed over COVID times, right? So they were working on projects, the supply chain got messed up, they weren't able to get their materials, they're stuck on a job, their general contractor is mad at them, when meanwhile they had no way of really controlling that. So they can do a better job of controlling their own destiny. They're acquiring materials in bulk up front, they get better pricing, and then they have it on available when they need it, right? And a lot of these guys, they've outgrown like their garage behind their house, but they're not big enough for a flex space that might be, 50, 75,000 square feet. So these are typically like 18 by 30 enclosed units. They have security cameras, those sorts of things. So it's a really great spot for that local contractor guy that's looking to grow his business, but isn't big enough for a big flex space.
Sure.
The other one is RV and boat storage. RVs are, people, post-COVID or during and post-COVID especially, people are buying RVs. The baby boomers who are retiring, a lot of them are saying, hey, just going to drive around the country kind of thing. But they need a place to keep these RVs because a lot of homeowner associations do not allow the parking of boats and RVs in the neighborhood. So they're buying, but they don't have any place to put them. So the demand for these spaces is really through the roof. And customers that are looking for these spaces, it's not unlikely that they will drive 100 miles or so to get to where they park their RV or their boat. But there's some people out there that, these are high-end vehicles, right? These RVs, some of them can be up to $500,000. So they don't just want to stick it out in a parking lot somewhere. So they're going to want that enclosed unit with the amenities, with the security, et cetera, et cetera. So that's another area within the storage niche that we're really excited about.
That's awesome. Now, are these mostly like value add plays where you're adding boat and RV parking or contractor garages to existing facilities like that you already own, or are you going out and finding facilities specifically for these two niches, or what's the plan there?
Great question. So we're about to acquire a facility in Wilmington, North Carolina, which is specifically a contractor storage facility.
Okay.
So it's 80% contractors, 20% RV and boat, but they're all those bigger units with the higher ceilings.
Got it.
We have a facility that we just got under a letter of intent, and that one is just RV and boat, and that one is what I would call like a Class C RV and boat. So there's not really any amenities. So what we're going to do is go in there, and we're going to add some amenities. We're going to add some coverage, and just do that kind of value add for that facility. On top of that, we are looking actively for development sites where we can build new contractor storage or RV and boat storage, depending on what's needed in that market.
Got it. And when you're looking for new development sites for those specific things, is it like is the criteria different than if you were looking just for a site to build like a ground up development, like ground up self-storage facility, like a Class C or B self-storage facility? Are you looking for different things? Because I would imagine the most valuable land, you're going to want to actually build, roll up doors, because you're going to get more money per square foot with real self-storage there versus like the boat and RV parking or contractor garages. So does that open you up to more opportunities though, to like buy land in locations that other people wouldn't be looking?
That's exactly right, Sean. Yeah. So the as I mentioned, the RV owner, right, they're willing to drive pretty far to go park their RV. But someone who's renting a 10 by 10 or a 10 by 15 storage unit, right, that customer is typically within 5 miles of their self-storage facility. So by going out a little further, we still look to be in the path of progress, but we can go out a little further from town to find those areas where RV and boat or contractor storage is going to be a better option.
That makes sense. So with ground up self-storage, location, eyes on the facility, I think is very important. Drive-by traffic, and even though there's a lot of people who say it's not, because you have Google now, but I still think it is pretty important. You're saying not as much with boat and RV parking, because those people who have the $100,000 RVs, they're getting online and they're looking on Google Maps and different, just searching for the best locations. They're not thinking of, oh, okay, what's the last one I passed? It's a bigger deal for them. And same, I'm guessing, with the contractors too. They're looking for something very specific, and it's less about drive-by traffic and more they're going online and searching for these locations. Is that right?
That's right. No, you're spot on. Yeah, the typical consumer who's looking for a 10 by 10,
Okay.
they're going to want that to be convenient, right? It's going to need to be in their, their path of the errands that they run. It's got to be near the kids' school where they drop them off, or the ball fields, or, the mall, or the, wherever in their neighborhood. But if you're a contractor looking to, park your van and store your gear,
Yeah.
you're probably a little more likely to, just find a spot that suits your space needs better, and not so much that it's, close to your kid's school.
Okay. Okay. Yeah, that makes sense. So, how have your facilities been performing in this market? Because I mean, everybody, a lot of people, they say occupancy is down. I know occupancy has been down on some of my facilities as well, and starting to see a little bit of a boost, in the month of July. But overall, it's been down quite a bit from it was a year ago. And so, I guess talk to me a little bit about that. And are there any other pitfalls that self-storage investors need to be aware of when they're going out and investing directly or investing in a syndication like you guys have?
Yeah, sure. No, you're spot on. It's definitely a different world. We're definitely in post-COVID times now. During COVID, we were able to aggressively, raise rates and those kinds of things because storage was so much in demand, because people were moving around, and they were needing to change that, spare bedroom into a home office and that kind of thing. So that time is definitely over with now, which is why we're really glad we put the operations team together that we did even before COVID, right? When we started, building out our team in 2019, obviously COVID was not on the radar yet, but we wanted to make sure we had a world-class team that had been through the cycles, right? Because real estate, I don't care which type it is. Every kind of real estate goes through a cycle. Every kind of business goes through a cycle. The economy goes through cycles, right? So it's just the natural way of business, and the natural way of what happens with self-storage. Now, COVID was, a different animal altogether, but now we're back to the normal kinds of things we need to be doing, and our occupancy is down. Our, rates at a lot of facilities are down. But we had anticipated that, and when we do our underwriting, when we're analyzing facilities to acquire, we definitely build in that cushion. And again, that kind of goes back to my aerospace days way back when I was taught by these really smart people. Is they always taught me to, under promise and over deliver, right, when it comes to private equity and projections and those kinds of things. So we've always been very conservative with our underwriting and our underwriting projections, right? But the beautiful thing is, where we are right now, I would not want to be in any other asset class than self-storage. And the reason is really threefold. One is, for 40 years, self-storage occupancy, even though it's down now, it's kind of gently meandered at every facility across the country between 80 and 90% occupancy, physical occupancy generally, right? Meanwhile, in that same 40-year period, we've had the booms and the busts and the booms and the busts and the booms and the busts, up and down. We had the Great Recession, we had COVID, we've had all kinds of recessions and expansions in between that whole 40-year period, ups and downs and ups and downs. Self-storage, steady, generally speaking. Number two is market penetration, right? So, which is a fancy way of saying that self-storage is becoming more popular. So you go back, 5, 6, 7 years, self-storage was, about 7 or 8% of households in the country were using self-storage. Not a lot. It's up to, about 11% now, and it's on the increase. Now, that might not sound like a big increase, 7 up to 11, but when you consider there's 120 million households in the country, every 1% move means 1.2 million new self-storage customers. And there's only 55,000 self-storage facilities around the country. So we've got increasing demand, and the supply is not being built fast enough to keep up. So we're excited about that.
I like
And
that. I
lastly,
might have to steal that one from you. That's a very good selling point. That's great.
yeah, feel free to steal it. I've got some charts here. I'll share them with you. Number three is self-storage is the safest asset class in commercial real estate. Now, how can I say that so emphatically? Well, if you look at the default rates on loans, retail is high, lodging is high, office is high, right? You start getting down, multifamily's solid, really good. I'm a multifamily investor as well. I invest passively in multifamily. Self-storage is zero. There are no defaults in self-storage. Now, could that change? Of course it could change. But I'm just saying, historically speaking, self-storage has zero defaults on loans. So if I'm an equity investor, that's a big thing for me, especially in this environment where, arguably capital preservation is more important than, really pushing for that high income or that high growth. So those are the three big reasons. It's a steady asset class, it's becoming more popular, and it doesn't default.
I like that. That's awesome. So tell me, how are you going about in this economy how are you going about in finding deals? How are you sourcing deals? And what kind of leverage do you get on these deals? What does that look like, right? Because I think, SBA rates are up to 7%, depending on the type that you do. Yeah, some of them, right, like 8.5, 9. I think like the 504, maybe you could get like a 6% interest rate or 6.5.
That's right.
But then, just regular commercial banks, local banks, they're still high. They're still 6.5, 7%. So it's not, I've been searching for deals for a while, and there was just they still want same prices that they did 2 years ago, but you guys are finding deals. You're doing a good job, right? And you have syndications ongoing. So what's the trick? How are you doing this?
Well, kind of like our core values, Sean, this one is something that, we really had to, put our heads together and SEAL team this one because it really is a challenging market. Things are starting to readjust, right? For a while there was a big spread between the bid and the ask, right? What sellers were wanting to sell for and what buyers were wanting to buy for. That we're seeing that starting to come back together. But the reason we've been able to do deals in this interim period is really hats off to my partner, Joe. He runs our acquisitions team, and they've just been leaving no stone unturned to the point where my partner, Joe himself, has gone on 2 road trips. So when you talk to these sellers, we're trying to find off-market deals just like everybody else, right? Mm-hmm. So these sellers have told us flat out, they said, I got a stack of letters from you guys, all you guys out there, a foot tall on my desk. My voicemail is full of messages from people trying to buy my facility. If you want to do business with me, you come down here and we'll, shake hands and talk about it. So my partner, Joe, has now gone on 2 road trips. He basically has crisscrossed the state of North Carolina, which is one of our target markets. And it's been working. So he goes down, he sets up meetings with owners. But then if he's still interested in a particular facility in and around, where he has an appointment, he'll just do drop-bys and just, stop in. So it's kind of like good old-fashioned, door-to-door sales kind of thing. But, these moms and pops, right, they're responding well to that kind of personal outreach because you can actually, look each other in the eye, shake hands, get to know each other, and that's the basis for getting the deals done that we've been getting done recently. And Sean, the bonus on top of that is a lot of these moms and pops have a lot of equity in their facilities, so that gives them the ability to offer seller financing. So the deal that we're about to close, we closed one last year. And this one we're about to close, seller financing. So these are interest-only terms, which means our cash flow is going to be higher, which means we'll be able to give our investors a nice dividend. And there's really hardly any underwriting. Like if you get a loan from a bank, right, you got to, turn over your tax returns and your K-1s and your firstborn and your personal financial statement and all that stuff, right?
Yeah.
These sellers, it's like, oh, well, they hardly ask us any questions about ourselves. I wish they would ask more, because for their benefit, I think it would be good for them to get to know us better. But I think they see, through interaction with Joe, and he tells them our story and tells them about our portfolio. And nobody knows the facility better than they do. So if they did have to take it back, they'd probably be okay with that, because then they could turn around and sell it again to somebody else. But we've been having a lot of luck with that too. So it's really just been hardcore, blocking and tackling, getting one-on-one, face-to-face with these owners, and that's really made all the difference.
Awesome. Yeah, very cool. I agree with you. I'd second what you say. It comes down to doing business with people like, and trust, and those are the ones who you actually shake hands with and have conversations with and spend a lot of time in front of. And as nice as it is to send out mailers and emails, it's not the same as getting out in front of somebody and having lunch with them or just touring their facility together. So
that's right.
I agree with you.
Sometimes they are so proud. They are so proud of their facility.
Oh yes.
They just want to tell you all the stories about it and how great it is and all that stuff. So yeah,
right.
It means a lot to them to be there in person.
Exactly. So you just gotta shut up and listen and let them talk. And
that's right.
Yeah, let them tell you all about their baby that they built from scratch, and it's cool. Correct. They should be proud.
Yeah.
They've
sure.
A lot of these guys have built multi-million-dollar facilities out of nothing. It's pretty amazing.
That's correct. Yeah.
Cool.
The American dream.
yeah, for sure. What would you say to people who are trying to get in right now, trying to get into self-storage? Those, I guess, who they're entering this asset class now, and they've heard all about self-storage. What would you tell those folks?
Yep. Well, especially these days, it definitely takes a lot of grit, going back to our core values. I mean, you've got to be persistent. You got to be able to grind through, because the deals are tough to come by right now. So if I was looking to get into this space, I would be okay with acquiring smaller facilities, right? So we're a bigger organization. We're certainly not big, but we're a bigger organization, meaning we have overhead and, salaries to pay and rent and all that good stuff. So, there's a certain point where a deal just is too small for us to look at, because even if we made an acquisition fee or we made a profit split on the end, it's just not going to be enough. There's not going to be enough dollars there to make it worth our while. So if you're just starting out, and maybe it's just you and a partner or you and a couple of guys. By the way, I'm from the Northeast, so when I say guys, it means guys and girls. So nobody get upset out there.
Yeah, same with the Midwest. I say guys all the time, and
right.
If you're talking to only girls, That's guys right. Doesn't mean gender. It's just people.
That's right. Use guys. Yeah. So if you're just starting out, I would say take a look at the smaller facilities, especially if they're local to you, because then you'll really be able to kind of cut down on the management expense. Because that's the other thing, on a smaller facility, you just have fewer units and fewer dollars to kind of spread your expenses over. So for a large organization like us, it makes it just difficult, right? Our expense ratio on a facility like that would just be too high. But if you can, kind of get your foot in the door, manage it yourself, learn the business, right? And then now you've got stories to tell. So you can go out to investors and you can say, hey, we bought this facility. Even if it was small, you can still tell stories and make it sound big, because you're still going to run into the same things. You're the customer challenges, the software, the ups and downs, the cycles of the market that we were just talking about. You're still going to run into all those things,
right,
just with a smaller facility. And, you can get loans on those, and, maybe you can find an investor to come in with you if you were just looking for, someone to be a passive investor. Of course, there's, we could probably do a whole episode, Sean, on, syndications and, how that all works, because you do have to do it the right way so you don't break the law. But that would be my advice is, start with a smaller facility and just start learning the business.
Cool. Awesome. So for those investors who are out there and they want to get to know more about you or Belrose, do you have any deals coming up, or what's the best way of getting in touch with you?
Sure. Yeah, well, they can reach out to me. I'm Tom Dunkel. I'm Chief Investment Officer here at Belrose Storage Group, and you can find us at belrosestorategroup.com. We also post a lot of my podcast interviews and other articles and interesting stuff on our Facebook page, Belrose Storage Group Facebook page. We also do that same thing on LinkedIn if that's your preferred platform. But we just encourage folks to reach out to us. We've got a lot of great articles on our website. We also have an ebook there that's a due diligence framework for people who are looking to get into this kind of investing. Maybe they're just not quite sure where to start. There's a due diligence checklist there that they can download for free, and it just gives them the things to look out for when you're looking to invest in a private placement, whether it's self-storage, apartments, short-term rentals, whatever it is. It gives you the questions that you should be asking. But always happy to chat on the phone or do a Zoom with whoever's interested in hearing me blab about self-storage.
And these are all, it's this 506Cs mostly, right? Or do you do 506C as well?
We're 506Cs, so our investors do need to be accredited. They need to be verified by third party. Sorry, you did ask about deals. We do have a deal we're about to close on. Unfortunately, it'll be closed by the time this episode is published. But we've got one on the heels of that'll be closing. Looks like maybe late October. We have a deal that's going to be closing then. We'll be doing a capital raise for that one as well. But yeah, we're in this business to help investors out there, grow their wealth and hopefully, provide generational wealth or at least, provide a little better chance at a solid retirement life. So
Absolutely.
that's what we really like to do here at Belrose Storage Group.
Absolutely. So is your email's Tom at Belrose Storage Group, or is it?
It's actually belroseam.com. Our parent company is Belrose Asset Management, so it's belroseam.com.
belroseam.com. Tom at belroseam.com. You got it. And then you
That's
have
right.
two websites, belrosestorategroup.com and belroseam.com. What's the difference between
That's
those?
right.
I know you said one's a parent company, but is the one just focused on self-storage and the other one's all types of real estate?
That's right. Yeah. Belrose Asset Management has a couple other businesses under that umbrella, but Belrose Storage Group is where all the good stuff is happening.
All right, cool. That sounds good. Okay, Tom. Well, it's been awesome having you on here. I appreciate you jumping on and just talking storage with us. And if there's anything else you want to touch on, if not, hopefully we'll connect again here soon.
Yeah, no, this has been great, Sean. You've asked some great questions. I hope I was able to add some value to the listeners out there. So appreciate the opportunity.
All right. Thanks, Tom. Thanks for joining us and being a part of our conversation today with Tom. We've gathered all the important links from today's show and we put them in the show notes below, so be sure to check those out. Now, if you found any value from the content today, we'd love your help spreading the word. Could you do us a favor and share it with someone else? Your support means the world to us. Interesting fact, most listeners, 98%, haven't subscribed yet. So we'd be super grateful if you could take a moment, hit the subscribe button on whatever platform you are using. It's a small action, but it goes a long way in supporting us. Thanks again for tuning in. And guess what? We have new podcasts coming out 3 times a week. So don't just be a passive listener. Let's embrace the work we were meant to do and make each day truly amazing.
Well, there you have it, ladies and gentlemen. Another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.